All right, everybody, I'm gonna ask one more time. Good food? All right? All right, perfect. All right, cool. Okay, I'm clap for food. We're Americans, we clap for food. But we also clap for money, right? But I think what they say, a fool and money shall soon depart, right? So it's about having the knowledge of what to do with it and how to move with it. I know a lot of attorneys. Attorneys know everything. No. It depends. Yeah, that's a good attorney answer. Attorneys are smart in spots. Well, you need to listen to the right attorneys when they know what they're talking about. I'm assuming Michelle is going to give you a little bit of her history, but who's familiar with Mutual of Omaha? Yeah, I think everybody. At the very least, y'all have a good marketing department. But Michelle is very smart, and I'm looking forward to her educating y'all on the stuff that she's known, because she's been, how long with Mutual?
32 years.
32. Wow. All right, please give it up for Michelle Owens.
I've been with Mutual for 32 years. I started in their law division when I was in law school, worked part-time, and drove back and forth to Lincoln. I've been in Nebraska my whole life. People ask why. I say family and friends. But yes, I've kind of moved around all over Mutual. So was in their law division, was in a retirement plans contracting area, worked in government affairs, figured out that was not for me, flying back and forth to DC. Much more of a homebody, so worked at our banks for a little bit with bank secrecy and money laundering, and then ended up in advanced markets. So I've had quite the journey. I've been in advanced markets for 14 years, and with advanced markets, what we look at is like tax planning issues, estate planning issues, business planning and protection, anything we can do to help clients, individuals, business owners with how to structure the right type of life insurance or annuity type protection, and just make sure that the tax issues are all covered. So one of the things I like to talk about, thankfully you guys are eating, so that's a good start. You're happy, right? Hopefully I won't bore you too much with some tax issues here. Do I have any CPAs? No? Good, I can say whatever I want. So, what we look at here is, I don't know if everybody understands, in retirement, you sometimes volunteer to pay taxes to the government. And so, this was interesting to me when I started looking at how taxes work, what we pay into the system, and how we can actually kind of manipulate it ourselves. I've written a couple articles for Aspire magazine on this topic, so I don't know if you read that magazine or not, but I want to kind of talk through this, just give some general education. Always have to show the disclosure that I'm not giving tax, investment, or legal advice to you, more of just education, but I'm pretty casual, so if you have questions with this, feel free to jump in. Randolph said I have as much time as I want, so watch out. So, how does paying $0 in taxes sound to you guys in the future? This is where, when I first saw this statement, I was like, this can't be true, right? That means you don't bring in any income. That's how you pay zero taxes, is you don't bring in any income. But when you start actually understanding how the different income streams that you receive all get taxed differently, and that you can actually manipulate and control in ways how you're going to pay these taxes in the future in retirement, I think it's a really cool story. And so I want to give you kind of the general, and then I know working with Randolph, myself, we can help on an individual level as well with kind of looking at your specific situation. So if we just start off with the federal marginal tax rate, a lot of people will tell you what tax bracket they're in, right? I'm in the 35% tax bracket, or I'm in the 20% tax bracket. And a lot of people might think that means I actually give up 20% or 35% of my income. We actually are on a graduated tax system. So the more income you make, the higher your tax rate is on those last dollars of income. So everybody that makes $11,900, if they're single, they are going to be in this 10% tax rate. Once you make over that amount, up to 48, and I'm looking at 2025 numbers, you now have 12% tax on the excess. So this is a graduated system. Progressively, it gets higher as you make more. The other part I think is interesting about this is in 2017, we saw a reduction in our tax rates and an increase in the bracket, in the amount of income you could bring in. So what was nice about this, you used to always hear about the marriage penalty. I don't know if you guys remember that. When we had the changes in 2017, you'll kind of notice here that pretty much all the way down to the higher income levels, you're going to now see it just being doubled. So there isn't going to be that same marriage penalty that was around. Here you can see all the way to the 32% bracket, you're seeing it doubled. If you made $250 as a single, or you make $500 as a married couple, you're in this bracket. So that was nice. We reduced that penalty. The other part of this that was nice, I don't know if you guys remember, in 2016, we were at a 39.6% as our max for our tax rate. Here you can see we have 37% as being the maximum. And in 2025, did you guys hear about the one big beautiful bill that was passed, right? So that actually made these tax rates and these brackets permanent. Now, when I say permanent, what does that mean for Washington, D.C.? Right? Maybe while we have Trump as a president, maybe just as long as if we keep Congress to the more conservative side right now. So for right now, what was nice for a lot of people who started worrying about the sunset of these brackets, we do have these probably for a couple more years. The thing that comes to mind for me is we don't know what's going to happen to taxes, right? So could we as individuals start taking more control and trying to make sure we understand that some of our assets in our portfolio are going to produce tax-free income for us? Something that doesn't make us worry about what these tax rates are. And you know, I see all of you, you're all younger than I am out there. We were all taught to put money aside and put it into what? Pre-tax retirement accounts, right? Don't pay tax on it now, pay tax on it later when you retire, because you'll be in a lower tax bracket. And my mom is 87. I talked to her about this when I started learning more, and I said, have you and Dad, my dad recently passed, but were you guys ever in a lower tax bracket when you retired? And my mom said, no, never. It just kept, so this idea, it wasn't as though it was wrong, but we're kind of learning we need to diversify our portfolios more. We need to make sure maybe some of our contributions we should put into a tax-free type bucket, try to save. But would it be smarter for us right now to pay taxes at these lower rates and know that in the future, we have set aside, we've had this compounded interest, this growth. Would it be better for us to know that we're just going to get that money out tax-free and not worry anymore? So I want to kind of teach you about that. Ordinary income, some people don't understand that ordinary income is going to include your 401k money, your IRA money, those types of income streams that come out, and that means that they're going to be taxed at your federal tax rates. And so that's to me something when you start looking at what people put in their retirement portfolios, we want them to have different assets. We want them to be able to be secure and know, hey, if I need to lower my tax, if I need to manipulate my tax one year, I could draw from this asset, where if in a year that maybe I have more deductions, I have more credits, I could pull from maybe my taxable IRA or 401k accounts. So how is your income taxed? Well, earned income is ordinary income. It's at your marginal tax rate. When you start looking though at long-term capital gains, they have their own tax rate. that is going to be something that I'll show you how to manipulate and possibly get long-term gains, those income streams out tax-free. You have short-term capital gains, meaning that investment wasn't held for at least 12 months, so it just gets taxed at an ordinary income tax rate. And then with non-qualified annuities, the interesting part to that is when you receive income from an annuity, a portion of it will be taxable gain, and a portion of it will be basis. It will not have a tax to it. And so that can fluctuate depending upon the annuity you buy and how long the term is that you're receiving those funds. The IRAs and 401ks, like I said, if it's a traditional pre-tax, it just gets added to your ordinary income. But the cool part here is Roth IRAs, 401k, or your life insurance distributions. Those three assets can give you income that is completely tax-free, and then it can give you other income streams and make those tax-free too. And that's the part I'll show you. I have software that can do that. Social Security. How many understand that your Social Security could be taxed? Right? Right. And it was all done quite a while ago. We saw significant changes. Everybody used to receive Social Security benefits tax-free. Now, depending upon how much other income, reportable income you bring in, your Social Security could be taxable too. And so I want to help you learn how to keep that tax-free. And then pensions. Unfortunately, a lot of people aren't receiving pensions anymore. That used to be a very popular form of income for people in retirement, and unfortunately, a lot of companies just can't include that as a benefit package. So pensions, though, would be a part of your ordinary income. What I like to point out is you might go to your tax advisor, or you might talk to someone who says, I'm in the 20% tax bracket. Okay, that means that they made enough income that the last dollar of that income is up into that 20% bracket. But it doesn't mean that effectively that is how much of your income you gave up. So I want to show you too, even though you might fall in a certain bracket, the actual percentage of income that you give up to taxes could be a lot less than originally what people are thinking. Do you guys understand standard deductions versus itemized deductions, right? The standard deduction is something we all can take. It was increased significantly in 2017. This was another thing that was made permanent by the One Big Beautiful Bill. A lot of people now are filing just using the standard deduction. It makes it a lot easier than having to itemize and track your different Scheduled A deductions, and that would be something you would do if you are itemizing. Right now, if you're a married couple, for example, in 2025, you'll be able to deduct $31,500 right off the top of the income that you're reporting. If you're over age 65, you're going to also have an additional amount that goes on top of that standard, $2,000 for a single, or up to, you can see, $3,200 if both individuals in a married couple are over age 65. So that's another way to hopefully help in retirement, be able to not count as much income and have it be taxable to you. Itemizing, like I said, before you would actually itemize, you would have to have enough expenses, mortgage interest, property interest, things like that. They would have to add up to over that amount before you would even be considering itemizing. Now, this isn't really necessarily just for retirement, but I wanted to talk about some of the new provisions so you guys are aware of them with the One Big Beautiful Bill. The first one I think is critical, and what's important with all these is these are only available for 4 years, okay? So keep in mind, these are temporary. They were too expensive to add them to the bill and make them permanent. So you want to take advantage of this, or if you know people who could take advantage of this, you do want to educate them on it. The senior deduction, I think, is so critical because it's going to allow a married couple to add to that what would that be if we were looking at 34,000 some dollars, to add another 12 to that. So you're going to be able to have over 45,000 of potential income that won't be taxable to you if you're over age 65 and your reportable income is in between this 150, 250. This new deduction is going to try to help people in that middle class range, those that are in retirement, try to save a little more on taxes. And I think initially some people were upset because part of Trump's campaign is you heard about what? No tax on tips, no tax on overtime, and no tax on what? Social Security, right? Well, I personally like this better, because what this is saying is, this is just no tax on retirement income, no matter what it is. So as long as you're a married couple making under 250, or a single making under 175, you should be able to have some portion of this new additional senior deduction for the next 4 years. So the next 4 years are years to try to manipulate your income stream if you're over age 65 to be able to take advantage of this. Also, if you're working and you're in an industry where you're receiving tips, you will be able to deduct up to 25,000 of tips. Once again though, there's going to be a phase out. Singles, that would phase out beginning at 150, and for married filing joint, it starts to begin at 300,000. But this should help people, because what happens if you don't report income? I know you don't have to pay taxes, but what could happen to Social Security benefits if you're not paying in and reporting income? Yeah, some people don't prepare, don't set aside funds, and then they don't understand why they don't have that same amount or a decent amount of Social Security. So what I'm hoping to see is maybe some people then will be able to receive some form or a higher amount of Social Security if they're truly reporting this type of income. The last one I thought I'd touch on is your overtime pay. So once again, he's going to give you a certain amount. The bill says up to 12,500 of overtime hours you won't pay any income tax on, and the same phase out limits. Do you guys have any questions so far, just on of the basics? Okay. Tax credits. What's the cool thing about tax credits? They work different than a deduction, because deductions reduce your income that you're reporting. Credits say we're just going to take it right off the taxes you owe. So we love tax credits. They can be substantial to people because a lot of times they're even refundable. Meaning if you qualify for a tax credit and your taxes aren't over the amount, so let's say you owe $2,000 in tax credits, but you have multiple children that you receive the new $2,200 tax credit of, you can actually get a refund from the government even though you didn't owe the taxes on that amount. So tax credits are much more generous, and like I said, with kids right now, they've increased the tax credit amount to $2,200. That's for kids under age 16. I believe you should get it for kids up to 26, because that's how old my kids still are. And I still pay for things for them. But what happens when you retire that you might not think about? You tend to lose a lot of the tax credits you were maybe receiving when you were working, and you might, if you owned a business, not have those same deductions because you would sell the business, or you would start maybe just working as a consultant now, trying to get out of that lifestyle. So a lot of times with retirees, they don't think about all the different deductions or credits that they were taking advantage of. And so sometimes taxes can kind of worry them on that first year, trying to figure out, wait a minute, how did this increase so much? So what I like to talk about here is there are ways for you to stop volunteering to pay taxes. And there's two income streams that we volunteer for, in some ways just don't understand well enough. So we end up paying taxes on Social Security income and on long-term capital gains income. And unfortunately what happens is if you report enough income to the government, even $1 over the amount, you now are going to have these income streams taxed. So, long-term capital gains. This, like I said, is, do any of you have brokerage accounts?
Not yet.
Right, okay. When you pull money from a brokerage account, from a managed account, that income isn't ordinary income. It is more than likely going to be long-term capital gains income. And it gets taxed at its own rate. Also, if you sell assets, if you sell property, you sell land, all these things are going to have gain, and the gain is going to be long-term capital gain. And it's going to be taxed at this other amount versus ordinary income. The interesting part about how this tax rate works is, what do you want? Should I do an example on married or on singles? Married, okay. So if we do a married couple, it would mean that if you pulled money from your brokerage account or from your managed account in order to use it as retirement income, let's say, you could pull up to $96,700 and not have it be taxed at all. If that was ordinary income, right, from maybe pensions or IRAs or things like that, we would be in a tax rate of probably around 15-20%. So what's nice about this is they're giving you a little bit of leeway. The trick is, this isn't just your long-term capital gains income that fills this bucket. At first, you have to say to yourself, what was my ordinary income? If my ordinary income was $50,000, let's say from a part-time job, that $50,000 just reduced that to now it's only $46,700 is left at the zero bracket. So what we want to do for yourself in retirement is to be able to say, how can I draw from income streams that don't get reported as income? That would be your 401k Roth, your Roth IRA, or cash value life insurance. Those three income streams are not reportable income. So I could, if I have a cash value life insurance policy, I could distribute from that policy $100,000 and still leave this whole bucket open so that when I pull money from my brokerage account, I'm in the zero bucket, right? So that's where sometimes we end up volunteering to pay tax, long-term capital gains tax, because we don't realize that ordinary income might shove us into the 15% tax rate automatically when we start taking those funds. So Social Security, like I said, is another one. Social Security has its own calculation. We can't keep this simple, right? We have to make sure that we keep all the CPAs in business. So Social Security says, we're gonna look not at your ordinary income, we're gonna look at your provisional income, whole new term. Provisional income is pretty much all income streams except for, the three things: Roth IRAs, Roth 401ks, and cash value life insurance. So when Social Security decides when they're going to tax your benefits, they have their own chart. And they say a married couple can have provisional income up to $32,000, and this has not changed for a number of years. This chart pretty much increases the money amounts every year with inflation. But Social Security, for some reason, this one has stayed consistent. They make it easy for me to remember. With this, once again, if you were pulling money from your Roth IRA, nothing is met here yet. It's not part of provisional income. So it would assume that you get 0% of your Social Security income taxed. But once I start reporting my traditional IRA, my pension, those different income streams, you start building up. And it's going to be a percentage of your Social Security benefit that now counts as income and gets included in part of your effective marginal tax rate. For that Social Security calculation to figure out where you fall here, 32,000 and then up to over 44, They look at your adjusted gross income. They add back in if you have muni bonds. Muni bonds don't have any federal tax that's owed, but they actually put the income back into this calculation. And then as a married couple, if you received $50,000 a year in Social Security benefits, they would put that here and only use half of it, 25. But that would be your total for provisional income. Not to get into the weeds too much, but once again, these income streams currently, you could receive as much as you wanted, and you would not impact the taxation of your Social Security benefits. Unfortunately, all those other assets there, they look at and every year calculate in order to determine how much of your benefits will be taxable. So if you could get all your income from these, you would keep your Social Security income completely tax-free as well. Medicare excess premiums. This is another fun one that a lot of people don't think about. Money that's going to be reported on your taxes could potentially cause you to pay additional premium into your Medicare for both Plan B and Part B and Part D. This is another way, like I said, just to make sure. Could we reduce not only the taxes we're paying in, but another thing would be kind of this premium penalty that you might owe. And when you're 63, that's when they start looking at your income in order to determine whether or not you're going to owe this penalty for premium. So that's a consideration here. If any of you have IRAs, 401ks that you've set aside money into pre-tax vehicles, and you want to maybe talk about with Randolph, can I convert some of these over to Roth? Could I do it right now so that in the future, I know I'm gonna have, my tax-free income? You want to try to plan to do that prior to 63, because that way you won't be hurting the income, because that's a reportable income when you actually convert and you want to move it into a Roth. That would be something to consider too, is, hey, maybe I do want to do some of these things early on so that I know I won't also have this additional penalty along with potential taxes. Questions, and then I'll do a quick case study, because I like showing numbers. Sometimes I think it helps put it into perspective. No? Are you asleep? No? Okay. All right. Yeah, I hear snoring. Somebody nudge him. So let's say we have John and Jane, and John and Jane are in their 50s. They're making a combined income of about $180,000. And they meet with a financial advisor. They've done a good job in accumulating assets. They've put money into pre-retirement, pre-tax accounts. They have brokerage accounts. They kind of have a plan in mind of what they want to do when they retire and what they're going to receive. And based on their projections, they think they should be able to keep about the same income stream, and that's when they're 65 or older. And they'll get about $50,000 from Social Security. They'll probably withdraw about $60,000 from their IRAs or 401ks, and then they have brokerage accounts that they'll manipulate, maybe take another $60,000 from. What do you guys think? What tax amount do you think they would owe if we just use today's tax rate? Because they're in about, I want to say it's like the 22% bracket. 24% bracket. So you think they'd owe about $24,000? Because that is, you start thinking about it, when people say I'm in the 20% bracket or I'm in the 25, this is where I'm at. That's what you're assuming. The software shows if we used at 65, their $34,700 is just the standard, and they both get that little increase of the $1,600. We can use part of the senior deduction because they don't get the full amount, right? Because they're over the 150, but they're only 180, so they didn't actually phase out completely. They would owe about $11,900, and they've actually given up 6.62% of their income. So it isn't quite as bad as what you believe you are in for this tax bracket. What is the important part here is the standard deductions that were increased in 2017 allow us to have a lot of our income not be taxed. So here, I would say to them, that isn't too bad. You're giving up $11,900 of $180,000 to taxes if things continue the way they are, because I'm basing this off current. But what if we took a portion of their assets in their portfolio, and instead of withdrawing those funds from the IRA completely, if we had cash value life insurance or we had a Roth in there, and we actually manipulated the numbers to try to lower their taxes, what do you think I could get it to? From $11,900. Same income. I'm not gonna tell them, oh, we're gonna keep you at a lower tax because we're gonna take less income. We're gonna pull that same 180.
About 3,000?
How much?
0.
Oh,
No,
I'm not that good.
about 3,900.
Oh, 3,900, okay. So in between, I'll say in between 0 and 3,900, all right? So if we pull from that, I can get them to less than 1% with the same thing,
That's
right?
pretty good.
Man, you definitely need to talk.
And this is where you love to be able to tell people that, hey, if we just change where we're pulling income from, you actually won't give up as much money to the government. Your assets might actually last longer for you too, because you aren't having to withdraw as much, right? Maybe they're withdrawing 180 because they know they have to give that money up, a portion of it.
Excuse me.
Yep.
You need an intern?
So, no, I love this concept. It's one of the things I talk to my kids about. I mentioned my kids, 25 and 26. When they were in middle school, I was talking to them about Roth IRAs, right? And saying, oh, if you earned that money, we have to put a portion of it in this. The embarrassing part of this is when they would bring friends over to the house, they would say, Mom, so-and-so's parents haven't explained to their kids what a Roth is. Oh no, this is the embarrassing part for you. But it is true, the earlier you start by, my kids almost think that they have to do it now. I don't think anybody's told them you really don't have to, but it's going to help them in the long run. I call it pay to play, right? Pay your taxes now so that you can play later and not have to worry about what your taxes are in the future. So I do want to give you proof. I don't just want to throw this up here and say this is what I was able to do. The software that we use that I can run for Randolph, it shows a client, hey, this was your original plan. You would have reported around $172,000 with adjusted gross income. And that's because Social Security will never be 100% taxable unless they change the tax laws. Social Security is still tax advantaged income. So I do want you to think about that. That income stream does still, at the max, it's going to be taxed at 85%, not the full 100. So if they came in, did what they originally planned, they would only take about $44,000 of deductions and exemptions, and they give up $2,700 because they were over that $150,000 phase out right now. We were able, because we didn't use all of the IRA traditional money, we used some of it from life insurance or a Roth, we were able to keep them under that adjusted gross income amount, so they got to take advantage of the full $12,000 senior deduction along with their $34,700 of just the standard. The other cool part of this is it made it here, so a full $65,000 remained in long-term capital gains 0 bucket, where originally that IRA money only allowed them to get 18 of it at 0 and bumped 41,000 of it into that 14%. So this is just saying, hey, I get the same income, but I'm going to draw it from a different asset to help me actually organize and make sure I pay the least taxes possible. So potentially, like I said, could save people $10,000 either to have more fun, go play more in retirement, or withdraw less from your accounts and make sure they keep up with your longevity. Because all of us are living longer, right? We all need to make sure that we have these funds set aside and that we aren't withdrawing too much. I've mentioned this a couple times, should have given a quiz. Name the 3 things, get a free piece of cake when you leave. But if you guys have questions on these types of assets, whether it's starting one, whether it's looking at the life insurance side, what's really cool about options for having Roths or life insurance is right now, if you're setting money aside, there might be a Roth option that you could pick very easily. If you make too much income to put money into a Roth, you can easily pick life insurance and be able to put the funds into life insurance that then gives you that tax-free income. Life insurance is interesting. Are you guys familiar that there's some policies that you buy for death benefit protection, and then there's others that you buy for the cash part? Right. So what we like to talk about is the cash value asset here, and why it's so unique, why it's really a great asset to put into your portfolio. You're able to do that without worrying about income limits, without worrying about contribution limits, and without worrying about when you can withdraw the money. Roths are the same. To me, having that tax-free income there, knowing that that would be something that grows tax-free, tax-deferred, that's going to be a great asset, and definitely something to include in your portfolio if you haven't already. I can take questions, I can be done, let you guys, is it networking next?
I noticed you mentioned the married filing jointly, but when I was coming up, earning all of those unnecessary amount of designations and letters after my name, we would say married filing separately are treated like lepers.
Yeah, they have probably the worst option a lot of times, unfortunately. Married filing separate, you lose a lot of different tax credits, a lot of deduction options. It's typically, I would say, definitely work with a tax advisor to make sure that that filing strategy works better for you, because most of the time, married filing joint is going to offer more opportunity for you.
And I know the way that people are able to get to the money in their life insurance policy is by borrowing.
Yes.
And a lot of consumers have a negative relationship with borrowing. Can you share any of your insight when it comes to what borrowing means?
You don't want me to get started on life insurance.
Maybe I do.
I am extremely passionate about life insurance and the fact that people aren't educated on how well it can work in a portfolio. I think if you can have it in your portfolio, everyone should, because it is an asset that you do have to make a commitment to it. You have to be able to say, I'm going to treat this like I would any other accumulation vehicle in my accounts. I want to make sure if I'm giving 10% of my salary to my 401k, let's say, maybe I look at the fact that my job, my employer matches 5%, let's say. If I'm doing 10, should I consider actually using that surplus 5 and maybe adding an asset like life insurance into my portfolio? Because when you mentioned the way that you distribute income from life insurance, you take withdrawals from Roth accounts, from 401k accounts. Those are just straight withdrawals, right? When you're able to take a loan out of life insurance, there's 2 options that you can take. One is a standard loan, where you just, when I borrow the money, I'm paying a 2% loan rate, and I'm being credited 2% from the policy that year. So that's a wash, right? Very conservative approach. If I'm a little more aggressive and I say, you know what, I believe in the market, I think the market's going to keep performing, I actually want to be able to earn money on my borrowed funds. You can do that with life insurance by picking an index loan option. And what that does is it says, you're going to maybe have a higher loan rate. Right now with Mutual's product, the loan rate is 5 and it's a max of 6. So that's important too. If you're getting life insurance, you want to make sure there's a cap on that loan rate. You don't want that to exceed and be something that's so high when you're ready to borrow that it doesn't make sense. But let's say I borrow at that 5% and then the market returns a 10. That's a pretty reasonable cap in the industry for cash value life insurance. I just made 5% on my borrowed money that I went and spent somewhere. It's still on the books. It's still part of my asset.
Arbitrage.
Now, what's that?
Arbitrage.
Yes, your arbitrage. So what is nice about that is I can potentially get more income from that asset in my portfolio than I would if I was just taking withdrawals. Now, it's not the only thing you should have in your portfolio, but it is a great addition to help diversify your accounts. The other cool thing about it, I put little asterisks next to the Roth, next to the life insurance, because you have special rules with those assets. With Roth, you have to be over 59 and a half to be able to take your money out. With life insurance, you don't. As long as you have cash surrender value in there, you're going to be able to use those funds whenever you want. People, we get some calls though, where people will say, I want to be my own bank. I'm like, okay, that's exactly what you can do with life insurance. You can be your own bank. And they'll say, okay, I want to start this policy and next year I want to borrow $200,000 from you. I'm like, what do you plan on contributing? Because if you're your own bank, you have to get the money in the bank before you can borrow it, right? So the only way life insurance is going to give you more right away than what you put in is if you pass away and your family gets your death benefit. So I want everybody to understand this isn't going to be something that you give us your premium of $10,000 one year and then the next year you borrow $200. It doesn't work like that. It's not that type of bank. But the cool part about it is you don't have a maturity term. When you take a loan from a life insurance policy, there is not a payback date. You could have that loan forever. When you pass away, your death benefit pays your loan back and it gives your family the rest of the money. Okay? And so the illustrations, definitely go through those illustrations, talk through, hey, what would happen if I borrowed and at this age I passed away? That illustration shows you all that type of information because it's critical to understand loans, kind of in air quotes, that's a way to get funds out of the policy more than what you put in. It's allowing you all that interest that's been building up in your cash value account to come out tax-free. And then someday when you pass away, it gets paid off with your death benefit. Now, you could pay it off. You could say, I've had people who are in real estate, they like to purchase properties. So what they wanted to do was set up an asset like this so that they could borrow maybe $20,000, $30,000, and then after they sell the property, put back that money. You can definitely do that, but you don't have to. So the key to these is making sure you have a commitment to funding, you have the right structure, you always want the lowest face amount possible, and you want to shove as much money as you can into it. So the funds are always taking advantage of the growth opportunity there. If you don't have enough in the cash value account, let's say you're only paying the necessary costs of the policy, there's nothing to build, there's nothing to take advantage of the gain. So you really want to make sure it's structured the right way, and then you want to be with a good carrier. And I don't need to tell you which one I would pick there, but I have lots of reasons as to why we are a great company to work with. We keep our promises to our policyholders. For all of you out there that remember Mutual of Omaha's Wild Kingdom, you watched it with your family on Sunday nights, you know, that's the company. We're not a lot of bells and whistles, but we definitely are gonna be there for people. So this can be a great addition. Like I said, I purchased policies for my kids. My goal there is I will fund these policies. When my kids were dependents, I can own those policies on them. My goal someday is if I pass away, they will inherit those policies with hopefully a lot of cash value, also with a really nice life protection policy for their own families. So I think it can work really well, because if I need to in retirement, I can pull money from those policies, even though it's on their life. I can go in and I can use those funds for myself. So it's a lot of planning, it's a lot of structuring the right need for you, making sure we meet goals. And like I said, working with Randolph so that we can look at your individual situations. Any other? Mm-hmm.
With the cash value policy, is there like a term, let's say if someone is cash, front loaded with a lot of cash, is there a limit to when you can actually access that cash, or is it kind of like immediate?
No, so I will say Mutual does not have a structure that works well. I call it like a single dump in. I inherited a lot of money, I don't need it, I've heard this, can I just throw it in the policy? We don't have a policy that works well for that. So what I like to do is say, let's take that money that you have, let's put it into like a 5-year or a 10-year immediate annuity. Make sure you're getting that guaranteed growth. Make sure every year that check can be your premium payment. And then that way you fund the policy more efficiently. If you dump a big amount into a policy, it makes the face amount really big. And then the next year, if you aren't putting that same amount in, then the face amount cost is eating away at your cash value. So it's just not an efficient structure. You would have cash to borrow from. I just worry for people, they could have a lot better result if they use the asset the right way. So I would always look at life insurance as a long-term asset. Let's at least, so there's a rule. Have you guys heard of modified endowment contracts? It's a term, a MEC. Yep, you don't want a MEC as cash value life insurance, because a MEC is taxed like an annuity. Even though it's life insurance, you broke a rule, so you have to pay taxes when you take money out. So that MEC rule is a 7-year term that calculates how much premium can go in a face amount and not violate the rule. So I always tell people, think of that rule, why it was put in place. It's because you really should consider at least funding 7 years before you start trying to use this policy. And think of it in your mind, like, can I commit to this for 7 years? If you can't, I would use a Roth, because Roths, there isn't going to be a negative consequence if you don't pay your contribution 1 year. I could get into the expense differences on policies too, but I know I'm way over my time, so.
It's very good, very good.
Okay.
Any more? Thank you, Michelle.
Yeah.
Everybody give it up one more time for Michelle Owens. And like she was saying, there's really 3 ways that you can get money from a life insurance policy. There's the sad way, the dumb way, and the smart way. The sad way is you pay $100, you get $1 million policy, you get hit by a bus. You just got a great return on your investment. But that's a very sad way to get it. The dumb way is you withdraw. And once again, it's not, if you choose to withdraw, that's okay, but you just created a taxable event. The smart way is to borrow. If you borrow from yourself and you don't pay yourself back until after you're dead, are you going to sue yourself? I don't think so. Because knowledge is power. No, knowledge is only potential power. Applied knowledge is power. So y'all just got a lot of knowledge today, but if you don't apply it, what does it mean? They used to say it's only 2 types of people. People who, y'all ever heard this? People who earn interest and people who pay interest. Y'all ever heard that? It's actually 3 types of people. People who earn interest, people who pay interest, and people who understand you have to pay a little interest to earn a lot of interest. And once again, if you treat a properly structured policy like you're supposed to treat it, you're not gonna run into a lot of issues. And y'all some smart people, y'all watch the news. I'm pretty sure y'all understand that there are life insurance policies under fire right now, right? It's because they try to sell it like an investment policy, like an investment. Do you want something to be an investment and get taxed? Or do you want it to be a life insurance policy and not get taxed?
Yeah.
Then somebody might say, well, if I put my money in the bank, it's protected by a Fed guarantee, a $250 guarantee, but if you put it in a legal reserve, you don't get that same guarantee. Why do you think they came up with that guarantee, that protection? Because people lose so much in there. When you realize that the reason why there's 250,000 insurance on it is because there has been a history of people getting taken advantage of, having things taken from them, and then you look at a policy that doesn't have it, you be like, hold on, it seems counterintuitive. You think that you would want to go with the one that has that protection under it, and that other one, but actually that's not the case in a lot of instances. And like she said, it's not a silver bullet. It isn't the end all be all, but you need, in my opinion, you need to have your serious money in these types of policies. Because once again, the older you get, you realize, all right, and once again, y'all can talk to, I talk to people that's 60, 65, 70 all the time. If you actually have a conversation with them, they will confirm that their tax rate is the same, if not higher, than when they were working. The same, if not higher, because guess what? You're no longer paying that mortgage anymore. You're no longer paying that education anymore. You're no longer paying in that qualified retirement account anymore. And then it just keeps pushing you and pushing you and pushing you up. So I do definitely appreciate you flying out, because I know you never want to leave Omaha.
No.
It's just water slides and just all types of stuff, right? All right, so y'all give us 5 minutes. We're going to set up for ACN. They're going to be talking about healthcare alternatives, y'all. But one more time, thank you, Michelle.